Rupal, thank you very much for joining us. You've had quite a record over the years. One, how did you do it? And two, is it sustainable? People say, well, you may have a hot hand, but then inevitably it turns cold.
Great questions, Steve, and thank you for that introduction. You're correct. At my former shop, I had a top decile track record in the institutional marketplace and a 5-star fund. I think what led to that is really my unusual background, which doesn't go away. I started out my buy-side career on the hedge fund side, and I think I learned a lot about risk management. And I think one of the things that a lot of long-only managers have in their investment discipline is they're focused on return management, and there's less attention paid to risk. By paying equal attention to both, I think this is why the record is as compelling as it is. For example, in the 2008 bear market, we had avoided the financials as early as in late 06, early 07, because even though we could see the returns that these companies were making, we assessed that the risk they were taking to make the returns were not symmetrical. And because of our attention to risk, we actually sold out of the investment banks. And as you know, with hindsight, that served us very well and served the marketplace very well if they had thought about risk proactively. So I think that's why this record is more repeatable, because the marketplace today requires you to pay equal attention to both and not have a one-dimensional investment process.
You mentioned risk. Every manager will say, of course, we assess risk. But you make a distinction, I'd like you to explain it, between normal metrics that money managers use and what you call the business model risk, deep domain knowledge, non-numeric, holistic.
Yes.
Numbers people hate that.
That's correct. You see, a lot of people, when they want to make a business scalable because they want to grow in size, they want to do something that's formulaic because that's repeatable, that's easily taught.
You can bake the cake again.
They can bake the cake, right, again. And I think that formulaic nature of that rule book does not apply in markets because markets are dynamic. They don't allow easy arbitrages or easy money. So those sort of strategies tend to not scale over time. Again, to back to your first question, what we try to do is, you're exactly right, we screen on risk. Most other managers will screen on valuation metrics or growth metrics, again, numerical metrics, which are easily quantified and frankly very historical because you can run those screens. Well, we screen on risk. You can't read about risk in the balance sheet. You can't read about risk in a newspaper. You actually have to think about the risk. And one of the key risks that you have to think about in investing as a stock picker is business model risk. So to take the example of many Japanese companies, they were very good at consumer electronics. Sony, for example, was a leader, a pioneer, charged a premium price for it. But their expertise was in miniaturizing stuff. And that helped in an analog world. When the world went digital, that expertise became irrelevant. That is what we describe as business model risk. You could not have read about it in their 10Ks, even if they were an ADR. And this is what I mean about differentiation. If you do something different, and it's hard to do and replicate, it creates a barrier to entry in the business. And as you know, that's very important for any business. That's what we do for our clients. And that's what we mean by paying attention to risk, understanding it from a non-numerical standpoint, a business model standpoint, because that's forward-looking as opposed to backward-looking numbers. That's where we differentiate.
So people who would work with you as you get bigger and bigger, how do you teach a holistic approach? I mean, it sounds kind of nebulous, with like a pinch of salt and making a stew. Okay, how do you teach somebody that?
You're right. I don't think you ever teach anybody something which is a craft. It has to be learned. And so as a practitioner, you try to apply those principles on a day-to-day basis. And teams of people who work with me, and I've done this now for 20 years, have always had, I don't think a team has to be large in order to be effective. It's not about quantity, it's about quality. So if you pick the right people and they ask the right questions, that's 90% of the battle won. And that's what I think a lot of people misunderstand about research is they go on fact-finding missions, and if you ask the wrong question, but you get the right answer to the wrong question, yes, you've got a lot of facts at your disposal, but that's not the art. That's not what you're after in investing. It's about how do you interpret the facts. And so with this team of people...
Can you give a quick example of interpreting facts?
Exactly. So a lot of people thought, you know, all consumer electronics companies in Japan are dead, from the previous example I gave you. Yet, when we looked at the facts, and the analyst, again, with the business domain knowledge, as you described, with that expertise on that sector, realized, well, there is one piece of consumer electronics that has actually not gone the way of the TV industry or the DVD player or the iPod, you know, all the products that got sort of digitized. And that product did get digitized, but did not go to the Chinese or the Taiwanese or the Koreans and low-cost manufacturers. That exception was cameras. If you buy a camera, you're still buying a Canon or a Nikon camera. And the genius of that interpretation of that fact, because everybody knows that, right? You and I see that in the marketplace. This is not inside information, but the interpretation was, what is it about cameras that makes that business different than other consumer electronic products? And the answer, so because of that question, then we found the answer, and that was the right question to ask, is that there is software, image processing software. And the Chinese and the Koreans are not good at software. This is essentially a software product. And the lens technology is know-how oriented, not rote manufacturing, not labor intensive, but know-how intensive. And that's why the Japanese have maintained their edge. And that's why you see the cameras that you buy in the marketplace still sustaining the sort of premium prices and the high quality that you get in terms of the output. So that's differentiation of research in terms of interpretation of facts and asking the right questions.
Now, in looking at the world outside of the U.S., particularly what we call emerging markets, do you pick a country, or do you have a list of companies and then go to a country?
We are bottom-up investors, so we absolutely look at the business first, and the country is almost irrelevant to us. You know, a company can be headquartered in
so you
Spain,
don't say,
or
that's in Indonesia, it's X because I don't like Indonesia.
That is correct. What we will do is we will incorporate the risk of Indonesia as we do the business model risk analysis, and we will quantify it and ask ourselves whether the returns justify the risk taken. So that will be always taken into account, but it's not a reason to eliminate ab initio. We think our role as investment managers is to look for opportunity wherever it exists in the world. So we won't rule anything out. One example, we can be very negative on China in terms of its economic growth rate, but there are some very interesting opportunities in China, just not in the sectors that everybody thinks about. So when we look at emerging markets, by the way, contrary to a lot of prevailing opinion, we are quite bearish on emerging markets. Perhaps that's a separate question, but to get to your question about, as bottom-up investors, we are bearish on China, but China Mobile, which is a telecommunications wireless telecoms carrier, 675 million subscribers. AT&T and Verizon combined don't have those many. Everybody wants to buy Chinese consumer, right? That's the holy grail. Well, this company happens to be called a telecommunications company because it's in the wireless business, but to me, it's a consumer company. I can get this company on 10 times earnings, whereas for a consumer stock in China, I have to pay 25 times. So opportunity can be found even within a market. It's a question of the lens that you apply and the questions you ask to get to it.
A couple of questions on that.
Sure.
You make the point that because a country is hot, has nothing to do with stock market performance. Why is that?
I think there is very little correlation between GDP and stock market performance, although the market players, participants often think the opposite. So they like emerging markets because there's higher GDP growth there. The conversion of that GDP growth to EPS growth, you know, earnings per share growth and cash flow growth, is actually very weak. And there are a couple of reasons for that. In emerging markets in particular, where there is the expectation of high growth, it's because the populations grow there, and that's fair, the market is growing. But when it comes to the corporate sector, they tend to be in capital-intensive businesses, so they issue a lot of equity and dilute equity shareholders to fund those projects. So that's one leakage. The other is inflation tends to be high in those countries. So in order to increase your profits, you know, it's very hard to contain your costs. You have to improve productivity. Most countries in emerging markets are very poor at improving productivity. Some of the best productivity stats tend to be in Western world, like Sweden, Japan, etc. So I think there is a myth that economic performance of a country and stock market performance are highly intertwined. Often they're quite the opposite. Indeed, China is a good example of that. China has had one of the best GDP performance in the world, and yet one of the worst stock markets in the world. And I think that's just one really big example of how the two are not correlated.
Even within countries, you find differences. Let's take Japan, which everyone hates because it's gone nowhere for 20 years, been a disaster. But you make a difference between, say, a Panasonic and a Canon. How do you do that? Why Japan, and then how do you make those internal distinctions?
Well, Steve, I think you're familiar with Ariel Investments, and you know that we pride ourselves on independent thinking. So when everybody has a fetish for emerging markets, we view it as a very crowded trade. We figured, let's look at a submerging market, Japan, which everybody thinks is, gone for dead. And we think that's a very flawed point of view. It is true that Japan has not performed for almost 25 years. And in the context of that 25 years, they have deleveraged. Some of the strongest balance sheets are now found in Japan. People are not paying attention to the facts. That's what we find. In fact, Moody's, just day before yesterday, upgraded the banking sector in Japan for the first time in how many years, I don't know. So this is just to give you an example that I think the market is missing the underlying reality. The other thing that's improving in Japan is the corporate governance. So many companies are announcing share buybacks and dividend payout increases. You expect that from the Anglo-Saxon sort of world. You don't expect that from Japan. That's a Keiretsu system. And I was in a meeting with Toyota just a few months ago. And this is a company that's very symbiotically affiliated with Denso and its auto parts component suppliers. They told me they had invited Hyundai Mobis into their offices, a Korean subcomponent supplier to Kia and Hyundai, because they said if they can supply us with cheaper parts, we will consider them. So I think the old regime, the old system in Japan is giving way to the new. The market is not recognizing that. To me, this is a renaissance. I know it's premature to call it for the entire Japanese market, and we don't think entire Japan should be bought. But within that, as you said, we cherry pick our exposures. We won't own Panasonic. We think it's yesterday's story. We will own Canon. In fact, we own it in very good measure. It's one of our top 10 holdings because of this camera business, as I mentioned. We also like Toyota. We like Nintendo. We like Murata.
Nintendo.
Yes.
Huge up.
Yes.
All ages.
That's right.
Crashes. Why Nintendo now?
Well, because it's crashed. and we think that one of the advantages of the video game industry, and particularly Nintendo, is that they own their software. Unlike other guys who just make the consoles, they actually make the games. So Super Mario Brothers, Legend of Zelda, Pokemon, you know these franchises. And I think you saw what Disney just paid for Star Wars. This is the power of characters and franchises. We think it's an extremely undervalued company, even if it does not succeed in the way that the Wii succeeded, that is a Wii U. Interestingly, in this Christmas season, Wii U is the only new console out there. And so I think that naturally, when you're the only game in town, sales are going to increase. And I think they've also learned their lessons. They've priced the console more appropriately. They're also very vigilant about being asset light. So all through this downturn, which lasted a couple of years, they really are extremely cash rich. They're like Intel. They understand only the paranoid survive. So they had a very large cash balance and buffer to ride through the storm and come back even stronger. This is the only video game company that has come back after being given up for dead many, many times. When the PlayStation came along, they said Nintendo's dead. Well, the Wii came along and blew the socks off every estimate and statistic out there, appealing to the young and the old. No video game console has ever done that. I think it speaks to the power of the creativity within that company. But because they're very long-term oriented and they don't mind missing out on a couple of quarters, the stock market, being somewhat short-term oriented, has sold off the stock from 70,000 yen to 9,000 yen. So a lot of the bad news is in the price. Risk reward is very attractive.
Now, you said or implied, I think, that
Yes.
Apple is the Sony of 10 years ago, 15 years ago. Why?
Oh gosh, not quite. But since you're putting words in my mouth, I'll take your bait. I think that people have to pose that question because Sony was the Apple of Japan 10, 15 years ago. And that's really what I was trying to allude to in our chat earlier, which is that there are companies who can be extremely successful for a while. And the context of that success can change. One of the reasons why Apple's iPhone succeeded is because they were the first smartphone to arrive. When you are a monopoly, you are going to, it's a winner-take-all market initially, but now you have more players coming into that spectrum. So naturally, you're going to see less economics accrue to you than before. The other is that all the larger carriers in the world, Verizon, AT&T, and so on and so forth, are quite concerned about the subsidies that they have to pay Apple in order to subsidize a phone to the consumer. They want a cheaper phone, and Apple does not know how to make a cheaper phone. They are a premium product. The carriers want a cheaper product. We think the Lumia, which is the Microsoft Windows platform launched by Nokia, is likely to be a contender, not to necessarily unseat Apple, but to take away a large chunk of the growth that Apple might otherwise have experienced.
So it's like what happened to Xerox. Canon and others put out a cheaper product. You didn't have to have a good, big product.
I could not have expressed it better. Yes, that's exactly the analogy the market needs to think about. So we are not saying it will happen. What we are saying, a good investor thinks about those tail risks and asks the question, are we paid for that risk? And in today's valuation of Apple, which is about $600 billion, where 2/3 of the earnings come from the iPhone. So yes, the iPad is successful, and you know, the iPod hardly makes a contribution to earnings now. We don't even think about the iPod. In fact, that was a first hit product. I think there is a risk that the market will be disappointed. The other advantage that Lumia has over iPhone, you see right now iPhone has had all the advantages, is the native maps. Maps are very crucial in mobile telephony. And Nokia has proprietary technology in maps, which are native. Native means you don't need a wireless signal. And we all know we lose wireless signal, you know, every once in a while. Not to mention when it's native and the granularity of the data. If you're in a shopping mall of Macy's, not only do you know how to get to Macy's, but you know how to get to the menswear section of Macy's. Now, that is really mapping at a granular level. And I think that Apple's maps fall far short. So there are lots of things like that. Interestingly, from a patent perspective, you know, when we use the iPhone keypad, and when we tap on the characters, you know how the character becomes bigger when we tap, and it's a useful feature. Well, that particular, the patent on that feature is owned by Nokia. So I think people confuse their experience with ownership of intellectual property. And this business is about intellectual property, as you saw with the fight between Samsung and Apple recently in California. So I think Nokia has a lot of intellectual properties that the market is underestimating the power of. And we think that's what if I were to make a pair trade, I would say that Apple is probably on its way down and Nokia is on its way up. A very controversial and contrarian point of view, I admit, but exactly what Ariel is known for.